Financial statements are not just numbers. There is a critical connection between the balance sheet and income statement. Once you understand how they fit together, you will finally see the complete picture of any company's financial health. In this video, we will walk through a practical example step by step, building a company from scratch. In just 8 minutes, you will understand what confuses most beginners. The balance sheet shows us what a company owns and what it owes at a specific point in time, usually at the end of a quarter or year. On the left side, we see the company's assets. On the right side, we see its liabilities and equity. It's called the balance sheet because both sides always balance. Think of it like this. The right side shows where the company got its money from, like loans from banks and investments from shareholders. The left side shows what the company did with that money, the assets it bought. The income statement, also called the profit and loss statement, shows how much a company earned during a period. It records all revenue, money coming in from sales, and all expenses, money going out for costs. If revenue is bigger than expenses, the company reports a profit. If expenses are bigger than revenue, it reports a loss. Think of the balance sheet as a photograph. It captures the company's financial position at one specific moment. The income statement is like a movie. It shows what happened over a period of time. Together, they tell the complete financial story. The balance sheet alone can tell you if the company is profitable. The income statement alone can tell you if the company has enough cash to survive. You need both. So, how do they connect? Let's work through an example. We start a company and need to raise capital. We get $1,000 from investors. In return for their cash, they receive equity, ownership certificates in the company. Now here is the important part. Our company has $1,000 in cash, but we also owe $1,000 in equity to those investors. Why? Because the company is a separate entity. The investors own the company, so the company owes that ownership back to them. On our balance sheet, we have $1,000 cash on the asset side and $1,000 equity on the liabilities side. But $1,000 isn't enough to start our business. We need more capital, so we get a $1,000 loan from the bank. Now we owe the bank $1,000 in debt, and our cash increases to $2,000. Next, we can buy the assets we need to operate. We purchase a building and equipment, machines, tools, and other necessary items for $1,000. We record this as plant and equipment, P&E, on our balance sheet. Our cash is now reduced back down to $1,000. Next, we order $500 worth of inventory from a supplier. The supplier delivers the goods along with an invoice to be paid in 90 days. The inventory becomes an asset on our balance sheet. At the same time, the unpaid invoice creates a liability called accounts payable. This shows how credit purchases add both value and obligations to our company. We now have products ready to sell, but we also owe money to our supplier. Now let's record some expenses. First, we pay interest on the bank loan. That's a cash expense for using borrowed money. Next, we record depreciation on our equipment. This isn't a cash payment, but an accounting adjustment that reflects wear and tear over time. For example, the truck we bought for $300 might now be worth only $250. Finally, we record wages for our employees and we pay in cash. These entries show how both real cash payments like interest and wages and non-cash adjustments like depreciation reduce profits on the income statement. Even though depreciation doesn't use cash, it still counts as an expense because it reflects the gradual loss of value in the company's assets. After all this time and effort, we finally make our first sale. We send an invoice for $4,000 to our customer and record that amount under accounts receivable on the balance sheet. This represents money the customer owes us. It took time to get the business moving, but now our company's economic engine is running. At the same time, we ship the goods to the customer. The cost of that inventory was $500, so we reduce our inventory on the balance sheet by $500 and record it as cost of sales on the income statement. Now we can calculate how the company is doing so far. Gross profit $3,500. From gross profit, we subtract our operating expenses, depreciation $100 and wages $300 to get operating profit, EBIT, of $3,100. Next, we subtract interest expense of $100, 10% of our $1,000 bank loan, leaving us with profit before tax of $3,000. Assuming a 15% tax rate, we pay $450 in tax, in cash, leaving us with a net income of $2,550, our final profit for the first year. Perfect, we have made money, and that's our complete income statement for year number 1. But we have a small problem. Our balance sheet doesn't balance. Our assets are bigger than our liabilities and equity. Remember, the balance sheet must always balance. Assets equals liabilities plus equity. So what's missing? We have recorded all cash, inventory, equipment, loans, and initial equity, but we forgot one key piece, the net income we just earned. That profit didn't leave the company as cash. It remains inside as retained earnings. By adding the $2,550 net income to the equity section under retained earnings, the balance sheet now balances perfectly. Profits earned during the year don't just appear on the income statement. They also affect the company's financial position on the balance sheet. The income statement is like a movie showing performance over time, and retained earnings are how that performance gets reflected in the company's snapshot. To understand this better, let's compare how the company rewards those who provide capital. Interest is the bank's reward for lending money, and it is paid in cash. Net income, on the other hand, is the reward for shareholders who invest in the company. Shareholders don't get cash immediately. The net income stays as retained earnings, increasing equity. Later, the company can either pay this out as dividends or use it to grow the business. Either way, retained earnings belong to the shareholders. This is the key link between the income statement and the balance sheet. The profit you earn during the year at the end changes the company's financial position. Understanding this connection is key to analyzing any company's financial health. If you want to dive deeper and see exactly how to interpret a balance sheet like a pro, check out my video on balance sheet analysis. Thanks for watching, and I'll see you in the next video.